Welcome to Wealthfinity, your one-stop shop for all things related to investing and personal finance. In this series, we dive into the topic of intrinsic value and its role in stock investing. Whether you're a seasoned investor or just starting to build your portfolio, understanding intrinsic value is crucial for making informed investment decisions. In this ultimate guide, we'll walk you through what intrinsic value is, how to calculate it, and why it's essential for long-term success in the stock market. So, sit back, grab a notepad, and get ready to take your investing game to the next level with Wealthfinity. The basics of determining intrinsic value of stock. Investing in stocks is a popular way to grow wealth, but choosing the right stocks can be a challenge. One important factor to consider is the intrinsic value of a stock, which is a measure of a stock's true worth. In this video, we'll discuss what intrinsic value is and how you can use it to make informed investment decisions. What is intrinsic value? Intrinsic value is the perceived or estimated value of an asset, such as a stock, that is not reflected in its current market price. In other words, it's the value that the asset would have if all the relevant factors were considered, such as its earnings, growth potential, and risk. It's a measure of an asset's true worth, independent of market forces. Why is intrinsic value important? Intrinsic value is important for several reasons. Firstly, it can help you determine whether a stock is overvalued or undervalued. If the market price of a stock is higher than its intrinsic value, it may be overpriced and not a good investment. On the other hand, if the market price is lower than the intrinsic value, the stock may be underpriced and a good opportunity to buy. Secondly, intrinsic value can help you make informed investment decisions. By considering the intrinsic value of a stock, you can determine whether the investment is likely to be profitable in the long term, rather than just relying on short-term market fluctuations. Finally, intrinsic value can also help you avoid buying into a bubble. During a stock market bubble, prices can become inflated and disconnected from the underlying value of the assets. By understanding intrinsic value, you can avoid investing in overpriced stocks that are likely to eventually drop in value. How to calculate intrinsic value? Calculating intrinsic value can be challenging, as it involves estimating future earnings and growth potential, as well as considering risk. There are several methods for calculating intrinsic value, including the discounted cash flow (DCF) method and the price-to-earnings (PE) ratio method. The DCF method involves estimating the future cash flows that a company will generate, discounting them back to the present, and then comparing that number to the current market price. The idea behind this method is that the present value of future cash flows is the intrinsic value of a stock. The P/E ratio method involves dividing the current market price of a stock by its earnings per share, EPS. The idea behind this method is that the intrinsic value of a stock is proportional to its earnings. A lower P/E ratio may indicate that a stock is underpriced, while a higher P/E ratio may indicate that a stock is overpriced. Intrinsic value is an important concept in investing, as it can help you determine whether a stock is overvalued or underpriced and make informed investment decisions. There are several methods for calculating intrinsic value, including the DCF method and the P/E ratio method. By considering intrinsic value, you can improve your chances of making profitable investments in the long term. In addition to the DCF and P/E ratio methods, there are several other methods that can be used to calculate intrinsic value. These include the dividend discount model, the residual income model, and the price-to-book (P/B) ratio method. The dividend discount model involves estimating the future dividends that a company will pay, discounting them back to the present, and then comparing that number to the current market price. The idea behind this method is that the intrinsic value of a stock is proportional to its expected dividends. The residual income model involves calculating the residual income of a company, which is the difference between its earnings and the cost of equity. The intrinsic value of a stock is then estimated as the present value of the expected residual income over time. The price-to-book (P/B) ratio method involves dividing the current market price of a stock by its book value, which is the value of its assets minus its liabilities. The idea behind this method is that the intrinsic value of a stock is proportional to its book value. A lower P/B ratio may indicate that a stock is underpriced, while a higher P/B ratio may indicate that a stock is overpriced. It's important to note that there is no one, right method for calculating intrinsic value, as different methods may produce different results. As a result, it's often helpful to use multiple methods and consider the results in combination, rather than relying on just one method. In addition, it's also important to keep in mind that intrinsic value is an estimate, and that the actual value of a stock may differ from the estimated intrinsic value. As a result, it's important to be cautious when investing and to consider other factors, such as the company's financial statements and industry trends, in addition to intrinsic value. Intrinsic value is an important concept in investing that can help you make informed decisions about stocks. By considering multiple methods for calculating intrinsic value and being cautious about relying solely on one method, you can improve your chances of making profitable investments in the long term. In conclusion, understanding the intrinsic value of a stock is an important tool for any investor looking to make informed decisions. It involves analyzing a company's financial health, future growth prospects, and various other factors to determine its true worth. By taking the time to calculate the intrinsic value of a stock, investors can determine whether it is overvalued or undervalued and make informed decisions about buying, selling, or holding onto their investments. Ultimately, the goal of this exercise is to maximize returns and minimize risks, ensuring that your investment portfolio is aligned with your financial goals. We hope that this guide has provided a comprehensive understanding of the intrinsic value of a stock and how it can be used to make sound investment decisions.